Hello to everyone. Today I am going to present State Bank of Pakistan monetary policy announced as on September 12, 2024. Sorry for presenting with delay because of my surgery. I could not manage it in time. Now, uh, there is a disclaimer. You must read it before the start of this topic. Now, here we are going to discuss about the factors influence the State Bank of Policy rate decision. Monetary Policy Committee observed the following development since the last meeting that was held on July 29, 2024. Global oil prices has fallen sharply, though they remain volatile. State Bank of Pakistan foreign exchange reserves are around 9.5 billion as of September, saying despite of weak official foreign exchange inflows and continuous debt payment, it's a positive sign that the State Bank of Pakistan managed its reserve at the level of $9.5 billion. Secondary market yield of the government securities have declined notably since the last monetary policy meeting. Inflation expectation and the confidence of business have improved in the last pulse survey, while those of consumers have has worsened slightly. FBR tax collection during July to August 2024 was lower than the target. So it's a mix of positive and negativity during this period of announcing the policy rate decision as compared to last period. Real sector recent high frequency sales indicator reflect a moderate pickup in the economy activity. Domestic cement and fuel sales, excluding furnace oil, increased by 8.5% and 6.8% on month-to-month basis in August, respectively. So, both showing the increasing trend. Basically, when the cement, domestic cement is increasing, it means the construction activity started within the country. Last business sentiment surveys also support this assessment of a moderate pickup as the manufacturing firm reported increased capacity utilization during the past couple of waves. At the same time, the Monetary Policy Committee noted that the outlook for the agriculture sector has weakened. Now, here, on the one side, we have observed the business and sentiments pickup. On the other side, the agriculture sector are weakened. This is attributed to an expected shortfall in the cotton production from the government's target, given the decline in area under the cultivation and substantial drop in the cotton arrival by the end August 24. Now, next is committee also observed that the continued ease in the inflationary pressures and the unfolding impact of the recent policy rate cut will support the growth perspective in the industry and the services sector. So it's the future outlook in terms of the effect of cut in the policy rate. On balance, therefore, the real GDP outlook remained in the line with the Monetary Policy Committee earlier assessment of 2.5 to 3.5% for the year 2025. Now, external sector in July 2024 elevated workers' remittance inflows and substantial improvement in the export earning offset an increase in the import and helped contain the current account deficit to 0.2 billion. So it's a very positive sign that the current deficit at the level of $0.2 billion. The reverse trend in the worker remittance continues in August as well. The global macroeconomic environment also turned favorable as manifested by the substantial softening of crude oil prices and relative easing of the global financial conditions. Import volume are expected to increase in the line with the ongoing domestic economic recovery. Improvement in the country's term of trade, mainly driven by the softening crude oil prices, is expected to contain the overall trade deficit in financial year 25. Export earnings are expected to remain stable as the growth in the high value added textile is expected to compensate for the likely reduction in the rice export. Now, on one side, we have the forecasting that the value addition in the textile sector will counter the reduction in the rice export. The Monetary Policy Committee observed that these factors, along with the robust workers' remittance, are expected to keep the current account deficit within the projected range of 0 to 1% of GDP in financial year 25. This program will help further strengthen SBP foreign exchange reserve. Fiscal sector during July to August financial year 25, FPR tax collection grew by 20.5%. Now, it's the future expectation. Monetary Policy Committee noted that the pace of tax collection in the remaining months of financial year 25 needs to be significantly higher than the current rate to meet the revenue target for the fiscal year. So, now here, one alarming condition is that in the financial year 25, they are going to increase the current rate to meet the targeted next year target. Fiscal consolidation achieved in the past couple of the years has supported monetary policy in bringing inflation down and restoring the overall macroeconomic stability. As a result, the gross public debt to GDP ratio has recorded a significant improvement, declined from 75% at the end of June 23 to 67.2% at the end of June 24. Monetary Policy Committee expected that the fiscal consolidation would continue through reforms aimed primarily at bordering of the tax base and curtailing the PSC losses, particularly by addressing energy sector issues, which would create additional space for the social and the development spending. Inflation outlook. Maintaining its downward trajectory, headline inflation eased to single digit to 9.6% year to year in August 24 from 12.6% in June 24 at the time of last monetary policy meeting, while core inflation declined to 11.9% from 14.1%. It seems to be a positive sign. The committee assessed that this decline reflected the impact of continuous demand and reinforced by the improved supply of the major food items, favorable global commodity prices, and delay in upward adjustment in administrative energy prices. Monetary Policy Committee also says the near-term inflation outlook to be susceptible to the same range. Now here we can observe a risk factor. Core inflation is still high, and the consumer inflation expectation increased further in the latest survey. Uncertainties stemming from the time and magnitude of the adjustment in administrative energy prices, future course of global commodity prices, and any additional taxation measures to meet the shortfall in the revenue collection. Now, again, they have raised the point of increase in the taxation, and they are going to take the measure. If the measure is against the non-taxpayers, then it will be a good sign. But if you are going to increase the tax rate of the existing taxpayer, then it will further suppress the taxpayer. On balance, the committee view a possibility of financial year 25 average inflation falling below the earlier forecast range of 11.5 to 13.5%. However, this assessment is contingent on achieving the targeted fiscal consolidation and timely realization of the planned external inflow. In the meeting held on September 12, 2024, in which the committee decided to reduce the policy rate by 200 base points to 11.5% based, uh, based on the factors we have discussed. So it's a big relief for the business community. And on the other side, when the policy rate decreases, the uh, investment shifts from the fixed investments to the business that that able to bring more economic activity within the country. Now, if you are interested to have update videos on banking and finance related topics, please do subscribe my channel. Thank you very much. See you with the upcoming video on uh, on the banking and finance related topic very soon.